Good morning.
Morning.
Thank you for being here this Saturday morning.
Thank you.
I open it up to questions. Anybody have any questions this review session?
Well, Professor, I'll start since I have my mic off or on.
Okay.
We sent you a spreadsheet and I just had a question about the warranty because we did the net present value and then added it to the warranty cost and did the inflation.
Okay.
No, we didn't inflate it. We added it and then it was a straight cost, the warranty for the bus and the engine, a separate line. And I wasn't sure if you had a chance to look at that yet. Darlene sent it last night.
I have not.
Okay.
Can I let me bring it up off camera here because I don't want, it's not fair to you to have other students see your work.
Well, if you want to talk to them first, that's okay. And you can get to mine later.
Okay, just by what you explained it doesn't sound correct. But let's take a look at it a little bit later, okay?
Okay.
Brittany and Stephen, do you have any questions of me this morning?
So I'm doing question 2, and then cash flow assumptions. I've been looking it up, so I think I kind of got the idea of it. I just wanted to make sure that I'm making the correct assumptions, I guess. So like
The
first
assumptions
input
are
that-
you following what we learned and what you've done in your assignments in class? If you're following that capital budget analysis, that's the cash flow assumptions that you should be following. So that's what you're using. You're determining the cash flows of determining the sales minus the expenses, taking out the tax, net income, and net income plus depreciation, plus or minus the working capital and the salvage value, if there's any, to determine the net project cash flows, and then doing the return analysis based on those project cash flows at the discount rate that you've calculated as the weighted average cost of capital. If you're doing that assumption, you're doing it correctly. That's the assumptions you should be using.
Okay, got it.
Okay, Steve. Anything else, Stephen?
No, I think that's it. I think sometimes reading the question, it doesn't really make sense to me until like I
Totally agree with
Yeah.
it. And also, please feel free to just hang out here and listen to other questions from other students if you'd like. This session, I'm here till like the noon hour, and students come in and out and they have questions, or they have, and then they're happy and then they leave, or they hang out and just want to hear other students' questions. Feel free to do that. That's what this is, just an open session for students to ask anything that they need. Okay.
Okay, yep, that was the other reason I was here, just to kind of
Okay.
listen in.
Great. And I think I'll address Catherine's discount NPV question in just a minute. So, Brittany, do you have any questions or concerns?
No, I kind of just came to absorb everything through the review session.
Okay. Well, why don't I address that question that Catherine had? So let me just get set up. I'm not going to bring up her spreadsheet, but I can give the overall viewpoint of that, and then if Kathy's team has specific questions, I can address them off review. So let me bring up something here. Hang on. Be right with you guys. Hang on. Okay. Here's that checklist that we've been looking at for the last few weeks in our class. And basically, the object of this case is you as the business student can interpret some information and determine whether the future projections of a possible product is going to prove worthy of the investment. In this case, the investment is $1 billion. Ouch. The $1 billion investment with a depreciable life of 20 years, is that investment of $1 billion plus working capital in the first year zero, is that investment of $1 billion going to be reasonable for the Road Kings trucks people here? And the reason why the Road Kings, and the reason why we're doing this case is because Michael Livingston, the chief executive officer of Road Kings, would like to take advantage of the changing market conditions of people wanting now to take mass transit or whatever, and develop a bus based on their historical situation of their company. They've done different types of buses or different types of vehicles, different types of tractors, different types of products. Now they want to develop a bus that appeals to the current market conditions that they're in Southern California of developing a bus. It's quite a decision that this company has to make. It's $1 billion. $1 billion that they have to go out and raise either through debt or equity or taking it from their profits and invest this and come up with a return alternative. Now, the return alternatives are simple. You have two types of buses. The bus is the same. One bus has a Detroit engine and another bus is the Marcus engine. And that basically is the center of your analysis because the bus costs are always the same, no matter what the product is. The labor is $50,000 a unit. The parts are $95,000 a unit. The SG&A are $250 million a year. The main part of the analysis has to do with one product costs us $25,000 and $1,500 a month for 5 years for warranty. Another product cost us $18,000 and $3,000 a month for warranty for 5 years. And that's the key part of the analysis. We're spending, or Road Kings is spending $7,000 more per unit for the Detroit engine. And because they're spending more, they're buying a more efficient product, one that's not going to fail as much. That means their warranty is only going to be $1,500. Or should they invest in a cheaper cost, the Marcus engine, which is $7,000 cheaper, but it's going to cost you $1,500 more a month for 5 years in warranty? That's the main part of the analysis, is for you to determine the return on those two different products with that concentration. The engine is the main determinant of whether this product is going to be available or give you a decent enough return. So that's what you're doing. So as you all have taken accounting in your lifetimes, hopefully, or statistics or anything else, you have to take into account when you're doing an analysis of what it's going to cost you today versus what it's going to return to you into the future. All right. And that's what all these variables that you have to figure out and divvy up and put it into that format, in which Stephen asked earlier. The assumption is we're doing a capital budget, determine the net cash flow per year for the life of this project. It's a 21-year project. Today is 0 plus 1 through 20, the active life of producing and selling the product in the marketplace. And why 20 years? On an investment of $1 billion in probably building and equipment for this asset to produce this bus, it's the depreciation schedule is over a 20-year life, depreciated over those 20 years, straight line, ending up with a salvage value at the end of year 20 of a $10 million, what's left over after you beat the hell out of those assets over the 20 years. So as we took accounting, we learned one of the key things of accounting is called the matching principle. The matching principle, where you match revenues and expenses in the year that they're incurred. Okay, that makes sense. If I'm selling my Detroit engine for $220,000 in a given year, and it's costing me $50,000 a unit in labor, $95,000 a unit in parts. If this is the Detroit engine product, it's costing me $25,000 to purchase the engine and install it in the bus. And then it's costing me another $250 million a year in fixed SG&A expenses. Okay. So I'm producing the product this year. Let's say it's 2021. I'm selling it in the market for 220, and those are all my costs. But there's one cost that goes out into the future, and that's the warranty. So my risk managers of this company, my risk managers, my cost accountants, whoever those people are, maybe even my public accounting firm, we ask them, could you tell us what's your estimation on the risk of the Detroit engine failing and the bus failing, and how long you think that risk is out there for? Well, they do an analysis, and you don't want to even know what goes into this analysis. That'll make your head spin. And it goes into this analysis, and they determine that if every bus you produce is going to have a lifetime of failure of 5 years. In other words, you produce a bus, you should guarantee your customers that they will get some guarantee of failure and us picking up the tab for it for the first 5 years of ownership. If they own the bus longer than 5 years, if it fails, they're out of luck. All right. And so the risk managers have determined that if it fails in 5 years, that the cost that they should include in the cost of producing this bus should be $1,000 a year for 5 years for the bus and $500 a year per year for the engine. So that's $1,500 a year for 1, 2, 3, 4, 5 years of the warranty's life. All right, we're in a predicament now. Mr. Hassey just told me about, and I learned in accounting, the matching principle. It means that every revenue has to match the year that every revenue and expense has to match the year that is being incurred. Well, I'm producing this product this year, so it's going to have a 5-year warranty. So that means I'm going to have those $1,500 of costs every year for the next 5 years. How do I get all those costs back into one number that I can apply and match it up with my other revenue and expenses for this current year? Well, that's why we learned and studied present value. The present value of that means that we can take future costs and incorporate them into one number. And then we have that one number which matches the revenue that number is generating in that given year. So that you as a business student have to determine what that present value is. So I have $1,500 a year for the next 5 years. Now, as we learned in our other assignments in this class, and this is one of the assumptions that I was talking with Stephen about, selling price per unit, variable cost per unit, and fixed costs all are inflated after year 1 onward. And in this case, the inflation rate in the Road Kings case is 2.5%. So selling price is going to go up 2.5% after year 1. Variable costs, the parts and the labor and the engine cost are all going to go up 2.5% after year 1. The fixed costs of $250 million are all going to go up after year 1. Well, that means also, I got to incorporate inflation in this warranty as well. But the warranty costs are going to be for every unit produced every year. And the warranty costs are 5 years of future costs. So wouldn't I include the inflation rate in my warranty cost calculation for present value? In other words, year 1 is going to be $1,500, and then year 2, 3, 4, and 5 are going to be inflated at that inflation rate. And now I have cash flow going out 5 years of expenses to maintain that warranty for my customers. So I determine the present value of that, and I'm incorporating inflation already in that number. So I don't have to worry about it anymore for the next 20 years. It's the same number every year. That's why I indicated in this case that you should have two lines of variable costs. One variable cost of the parts, labor, and the engine cost, and that'll be inflated at the inflation rate after year one. But you're including the inflation rate in your present value calculation for warranty, so you don't need to inflate that after the initial cost determination because inflation is already in that number. That's what I'm looking for in your analysis in this case. And now, what do you mean by that? Let me just bring up something else here. See, it pays to get up early and come to the review session. Damn. All right, hang on. Okay, here's the solutions to assignment number 3 that we've just had a week or so ago. And I have posted the answers. And for people who posted their work a little bit later, those postings will be up this weekend. But this is the solutions to case number 3. You are to get or to assignment number 3. You are to get a positive NPV, return, internal rate of return, and so on, and end up giving it a go because you're making money. And this is what I was looking for with a weighted average cost of capital of 7.55%. Right? Forget about all that. But look what we did in this problem, and all of you did this very well, is you determined today's cost. This is like year zero means like this is 2021. That's today. And then this is 2022, 23, 24, 25, and 26. You're going out into the future. Here's what it's costing us. The investment in the working capital, $910,000 this year. And then you're determining the future cash flows. Well, you're doing the same thing as determining the warranty that I just described. You're determining the cash flows going out 5 years of that warranty, and then you're discounting them back to determine the present value of that amount, and that will be your per unit cost for every of the 11,000 units you're selling and producing every year for 20 years, because you're going to be including inflation in that projection, and you're discounting it back using, just like I did here, how do we determine the present value of a flow of cash flow? Formula, function. You guys are old hat at this, but I'm going over it. Financial, look for the NPV function. Under financial, you put in what's your interest rate, or in this case, the discount rate, which is 7.55% in assignment 3. And in determining your cash flow values, and this is what you'll be doing for the warranty going out 5 years, year 1 through year 5, and you would be getting that cash flow and discounting it back at your discount rate to determine the net present value. That's how I got this number. We got this number here. But you'd be doing exactly the same thing. Oh, in this case, this is cash flow and profits. In the warranties case, it's expenses. To maintain the customer confidence in your product that if it fails, if your bus fails within the first 5 years, they can return it and get their money back or get it fixed. And that's what this cost of $1,500 a year is, setting aside the probability that there will be some failure. And the reason why it's higher for the Marcus engine, it's $3,000 a year, because why? It's a cheaper engine, so the likelihood or the probability of it failing is greater, so you're going to be paying out more in warranty. That's what I'm looking for in your warranty calculation. To project out those 5 years and then have to discount them or present value that number so it can match the year that you're producing that unit, In this case, it'd be 2021. But the number is the same every year because you're including inflation in your discounted cash flow. Kathy, does that make sense to you? I think I scared her away.
Oh, no, I am sorry, I was trying to unmute. I kind of think that we need to do the 1,500, put it on a separate line, inflate it, and then it will be discounted at the bottom because it's discounting the entire project. I think.
No idea what you mean there, but I'd have to take a look at it, and I can look at that after after site. You know, I'm not trying to demean this anybody. Don't anybody get mad at me for saying this, but it really is not that difficult. It's just understanding the concept of what you're trying to do. That's the most important thing. The arithmetic is, you've done it already. You did it in assignment 3. You've done it in other problems. The challenge arithmetically and analytically wise is not that difficult. The hardest thing is getting your mind around the concept. If I'm paying out something going out in the future, in order to match that expense with in the year that unit is produced, I have to do a present value analysis to get that cost into one number.
What I have a question. Once we get that net present value of the 5 years,
Yep.
And we use that number as a warranty for year 1 through 20.
Yep.
Now, are we going to take into account a 2.5 inflation rate as well?
Jose, you weren't listening. You include the inflation in your present value calculation of those 5 years of costs.
Oh, okay.
Why would you inflate it again? If you do an inflation once, you don't have to inflate it again, because remember, you're just dealing with 5 years per unit. You're not going out the full 20 years. Every unit produced in year 10, you're producing the same unit with a 5-year warranty. So you don't have to worry about your parts and labor are going to go up in cost, but you're still producing the same warranty, and you're including inflation in that warranty cost.
Okay.
I know. See, that's why I was just saying, this is difficult, not difficult. It's just something different that you have to get your mind around to say,
Yeah.
this doesn't, because I can't tell you how many spreadsheets I've seen in the last 48 hours where every spreadsheet had warranty costs going out from year 1 through year 5. I'm not laughing about that, but I'm laughing at my cat who's trying to horn in on my session here. Every spreadsheet had warranty going out year 1 through 5. And then after year 5, there's no more warranty. I'm saying, wait a minute, what happened to the product that's produced in year 6? They don't have a warranty? What happened to the product that produces in year 15? They don't have a warranty? Sure they do. That's why we do a present value analysis, to have one number representing those 5 years for every year.
Yeah, it's starting to make sense. It's not difficult. It's just wrapping the
Exactly right. That's exactly
mind around. It's like, I know later on I'm going to be like, oh, okay, yeah.
When you guys see the solutions, when I post the solutions after you guys post this and the course is over and I put all the solutions into Blackboard, you're going to go, you're right, Mr. Hassey. This is not that difficult. What was I thinking? But again, that's easier said now because you got your minds all involved in this. And it's like driving you bananas. I can understand. Listen, guys, X amount of years ago, I had the same type of case in school, and it drove me just as nuts. I had to figure it out too. It's just part of what we're doing here is we're making you learn. We're not making you, but we're asking you to be a critical thinking, to take a look at a number and do it a way that doesn't really make sense or understand, but it's the correct way. It's having you be a critical thinker, to look at information and apply it to the case at hand. Here the case at hand is I'm producing a product every year from year 1 through 20, and every product's going to have a 5-year warranty. How do I get those 5 years of costs into that warranty? I do a discounted cash flow, present value, and then I take that number, whatever that number is, and multiply it by 11,000 units every year, and there's the total amount of my warranty every year in dollars. That's what I want you to do. Now, Mr. Ayala, are you there?
I'm here.
How you doing, John?
Pretty good. How you doing today?
Where are you calling from today?
Poquema.
Pacoima. Oh, yes. Anything going on there exciting?
Not much. Not really.
Okay. You say, hi, professor, can you review my team's Excel, please? I'd rather not do that in front. If it's okay with you, do you want me to review it in front of all the other students?
No.
No.
Yeah. So
sorry.
what we'll do is either I'll review it and send you an email with what I see, or we wait till everybody's gone and we're in by ourselves, and then I can review it in front of you. I think the best procedure would be for me to, you've already emailed it to me, right, John?
Correct. I did.
Okay. I haven't looked at anything this morning. So once we're done with this review session, I will review it and email you my observations. Is that fair?
Yeah, sounds perfect. Thank you so
Okay.
much.
And Catherine, I'll do the same thing with your team as well for the probably, what's this, the fourth time I've looked at your damn spreadsheet? I'm teasing. I'm teasing.
Yeah, I went ahead and emailed my spreadsheet as well.
Who's that? Jose?
Yeah.
Okay, Jose. I will, when we're done with our session this morning, I'll go through your team's presentations and I'll review those and then email you back what I see. Okay.
Okay.
But I hope maybe once I email it back to you after what I'm talking about here this morning, it might make a little bit more sense as well.
Yeah, I see the correction I need to do. on
Okay.
the warranty.
But I'll look at it anyway and send it to you.
Okay. Thank you.
Also, I'm recording this, and so I will place this recording into our Zoom links as soon as I get the recording back from, and you also can refer to this as well. All right. So I kind of went about Catherine's question in a roundabout way, but I think you kind of got the gist of it, of what we're looking at. If I may I want to take a couple moments now to just take a look at the paper. And let me just bring something up here. So hang on just for a moment. Okay, here I come. I've given you a sample paper, and I want to highlight a couple of things. You know, basically, except for the warranty, this is an analysis, this capital budget analysis, even though the numbers are bigger and it's for a longer period of time, it's basically the same of what we've been doing in assignment 3. That's not, shouldn't be, and once you get the warranty thing straightened out, shouldn't be a big issue. The key thing with the grade is making sure you all tell me and interpret the information and relay it into a presentation format that tells me that you're qualified to continue on with your business education and get a degree, because the analysis is one thing, but also presenting it and writing about it and explaining it is even more important as far as I'm concerned. Because down the road, you all are going to be leaders. You're going to be managers. You're going to be owners. You're going to be supervisors. You're going to have people do this for you. Your job is to interpret what they do for you and then explain it, interpret it, analyze it. And that's why you're going to college, because you're going to be the person who's determining what the strategy should be based on the analysis. That's what you're being trained for. And especially if any of you go on within a company, you'll adapt to the culture of that company, but they'll expect you to be able to interpret data and analyze it. That's what we're doing here. So how to present it in this case is just as important as coming up with the number crunching. So I just want to make sure that when you when your team puts together your paper, you spend some time on making sure that that paper is what you want it to be. Does it explain and answer those 9 questions in that format? Now, this paper is a sample of this. It's a different type of study, but it's the same type of sample where you have a title page that explains to me what this is all about, and then an abstract page. An abstract page determines or tells me what you're trying to do in this paper. What's the goal of this paper? And then you get into the analysis, and basically you're doing an energy cost situation here, because you're doing an analysis here for Road Kings, for Mr. Livingston, where you're trying to do 2 things. Is it financially viable to invest in these Detroit or Marcus bus engine buses? Is it financially viable? And also, does it fit the situation for the time and the market that this company is in now? So it's not only a financial analysis, it's a marketing analysis. It's a cultural analysis. What is the culture and the history of this company? Can they do this? Can they switch gears and produce another type of product? I want a little bit of review about that. I want a little bit of thinking about that. It's not only number crunching, which is the main part of it naturally, but there's other things to look at in this case and be part of your paper. And then notice in the paper, I've added, yes, you're giving me the spreadsheet with these tabs and numbers going every which way, but if you can find a way of consolidating some of that information into tables or charts in your paper, that's to your advantage. Just don't have 8 pages of line after line of information. Spice it up a little bit with some tables, with a chart, with anything. A chart, overall analysis, very nice differences between the 2 products, whatever. Any way that you can add to that, that influences my interpretation of how you can present this data is important. And don't forget the references, because at this point in your education, I randomly check these suckers out. All right. I really do. So if you put down, and you don't have to put down your textbook as a reference, by the way. If you put down that I went to if you went to Consumer Reports of July 2019 and got some analysis, I'm going to click on this link and I'm going to check that out. Or if you applied to a book that you read or an excerpts from an article, I'm not going to do it for everybody. I don't have the time, but I'm randomly going to check some of these things out. And if they're not accurate, that's going to be a problem. So make sure you spend some time and have one of your team members or all of you spend some time on putting this together. Don't do the paper at the last minute and go and just think, oh, I'm just going to throw anything at Hasse and he'll accept it. That's not the case at all. And for example, for all of you who are here today, you should have as a reference my discussion with you this morning, because I'm sure some of you are taking this information and it's going to help you doing your work. You need to list that as a reference. And notice this student here had outside consultations in addition to their references. I need to see this stuff in your paper. Do not take that lightly, because I'm going to check these things out. Not for everybody, not everyone, but I'm randomly, and I have a system by which I do this. I'm going to randomly check these out. And if they don't come out the way you say they come out, that's going to affect your grade immensely. So please take note of that. Don't take that lightly. This is the main reason for this assessment. You've already done this capital budget analysis in assignment 3. Most of it, I think you know how to do it. This is more than just that. And that's why I wanted to stress this in the review session today. So please take note of the format. Notice how it's double spaced. Notice there's no spelling errors. Make sure you check your grammar. And make sure you have it set up with the title page. You can put in a table of contents. That's not a big deal for me, but some students like to put in a table of contents. That's okay. But make sure you at least have a title page, an abstract, and references, because I'll be looking at those very carefully. And I wanted you all to see that today in this review session. Okay. So I've answered some questions. I think some more people have now come on. And so I have done my spiel for this morning. If any of you have any specific questions remaining, please ask them now. If not, you're still welcome to hang out and listen to the questions of the students and hear how I respond and ask that. We've discussed quite a bit already this morning. For some of you who have come on just recently, I'm recording this session, so I will post the recording later on. We've talked about the warranty calculation and the discount rate and all that jazz. But you're free to welcome. I'm going to be on this session for about another 45 minutes. And you're welcome to stick around, or you can be excused. And for those teams that have already sent me some work in the last 24 hours, I will review those this afternoon after this session and get back to you with my comments. So I open up the session. Anybody have any questions, please?
I'll ask a question.
Yes.
On the instructions for our paper, it says 1 paragraph for each of the 6 questions, limited to 5 pages total. But we can do more than 1 paragraph.
You
Right.
certainly can.
Okay.
That's the minimum requirements. That's what I'm looking for. But you can do a lot more than that, Catherine, if you want to.
Okay.
I don't want a lot of, I can say this right nicely. Because sometimes students like just blah, 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 BS, 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 and they're not saying anything. The reason I put that in as 1 paragraph is be concise, answer the question, provide the information, provide the interpretation, and move on. I don't need all that kind of nonsense. But some students, if you want to give the good, concise answer, it's going to take maybe even a page per question. But as long as I'm reading good written assessment interpretation, I don't want to see a bunch of blah, 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 blah BS stuff. Okay, that's my point with that.
And it sounds like you want more about the project, not so much what's going on in the market as far as electric vehicles, or that would kind of be with the energy.
Yeah, that's the first question.
Yeah, that would be important. Okay, no, that is important.
That
Good,
is very important.
good. Thank you.
This is just not a number crunching paper. This is a whole analytical paper on a company in its marketplace and where they're doing business and their history of changing their business model a little bit to get to another new type of product. And that requires more than just number crunching.
Now, for that similar question 1 in the energy cost situation, we can use information that's currently available for
Sure.
the year and
Yep.
kind of
Yep.
back and forth with it. a
Yes.
little bit. Okay.
Yes, I think. Matter of fact, I'm remembering, and I'm not asking you to do this at all, so don't even consider it. But 1 year, years ago, I gave a similar case like this, and I was looking at the energy situation, and one of the students interviewed somebody from Metrolink and put that video as a link into their paper. That was pretty good. That was pretty good. Not please, you don't have to do that. That's not required at all. But that was clever. They interviewed somebody from Metrolink, asked about the situation in Southern California, and put that little link into their paper. That was quite clever. They still didn't get an A though, because they did the numbers lousy. So haha.
That was a good idea. I did see a bus yesterday and I was like, oh, I wonder if that's electric.
Yeah, I know the buses out here in Claremont and out in whatever they call that Inland Empire bus area, they're all electric out here now.
Ah, yeah, I never paid attention before. Are they really quiet then? Can you hear like the cars, how quiet they are and you can't?
Yeah, they're very quiet. And there's no, like when they start up, the billowing diesel smoke going every which way that we used to have. That's gone. It's kind of nice.
Well, I remember in the 80s or the 70s when I was young in elementary school, we used to have smog alerts and no recess. You know, we had to, because I lived in El Monte, so in the San Gabriel Valley, we always had poor air quality.
Yep. I remember when I first came to California, it was awful. Oh my God. In the early 1980s. Terrible. Now it's bad because of all the fires.
Yeah.
Boy, if any company could invent a way of cleaning the air, just like in the offices, we have those air scrubbers or those air things. If somebody could come up with a way of doing that for the entire environment,
Right.
that sounds like a pretty expensive task. But if somebody ever could, if the technology ever could do that, there's a moneymaker.
Just like the desalination for the water, you know, to
Yeah,
the ocean
true.
water.
That's true.
It's
That's
just expensive.
very expensive. But supposedly someday they're like, just, you know, yesterday I read and I thought it already happened. There's now a cure or a shot for malaria. I thought already thought there was a cure for malaria, but evidently there's not. And it was just developed this week and announced that malaria, now you can take a shot and don't have to worry about getting malaria, especially in areas where there's very poor sanitation, because malaria is not a virus, it's a parasite. It's, you know, whatever, I don't get into details, but somebody has just come up in the last week, a company has just invented and said it works, a shot for malaria. That to me is unbelievable, because you know how much malaria has killed how many lives over the history of mankind? My God. And now they just came up with that. So one of these days in somebody's lifetime, somebody's going to be able to do all these things once the technology gets to that point. It's amazing.
Yeah. Well, what gets me about this electric vehicle thing is how the power grids, how they have to do these, you know, vacations and turn everybody's power off because of the fires and everything. And I'm like, okay, we're all going to go electric, and now there are all these fires that we're having, and so everything is going to shut down.
Yep. I think that's one of the reasons why the technology is now progressing to develop fuel cells and battery cells where you don't need to charge your engine, like fuel cells. If anyone knows about space travel, most of the engineering and the electricity on spacecrafts is done by fuel cells, which produces its own electricity through the combustion of water and air and I don't know, but it's called fuel cells. Well, it's just too expensive and also too dangerous to put those in automobiles. Wouldn't have you if you have an accident and the fuel cells you could blow up or whatever. So that's where but there's a lot of companies. I know Ford is working on this because I'm a stockholder, and that's why I'm a stockholder, is because I think it's cool. They're developing these fuel cells so you don't have to have electricity to charge your cars. The fuel cells will power your cars internally. Whenever that comes, you know, we'll wait and see on that. But that's some of the technology they're working on, is to develop those type of power generating systems within the car. Which to me is, and to fill your tank on a fuel cell, you just have to put water in it. So then again, well, we're running out of water, but whatever. But so that's how you would power your cars. You fill it with water, and then the water would combust with the CO2 and all that stuff, and it would create its own power.
Yeah.
Amazing. But we're many years away from that.
Well, and I always thought, well, we have a roof, we could put a solar panel on our roof and our hood, but that's not enough. There's not.
Yeah, that's not the turnaround time and the power necessary for that ain't going to happen.
I know.
And it's because that's again, but then the technology could develop to do that. Marissa, you have a question, please.
Yes, I apologize if you've already gone over this, but I had a question about the training expense.
Yes. Oh no, we have not gone over that. Please.
Okay, so I'm under the impression that the training expense is going to be added to the fixed cost the first 2 years. Is that correct?
You're exactly right.
Okay. So that would be 100 million for the first year added, and then 100 million for the second year added.
That's correct.
Okay.
So technically your fixed cost in years 1 and 2 are $350 million.
Okay.
Do we not inflate that for the second year?
I would.
Okay.
I have mine set up on a second line just as.
That's
training.
fine. That's,
Okay.
that's fine. That's fine. Matter of fact, the more lines and the more information you give me, the better I like it. But I don't want you, spend all your time telling, well, does Hassy want this line? Does Hassy? So if you want to incorporate, as Marissa just said, just add the 100 millions to the fixed cost rate in years 1 and 2, that's fine. Or if you want to have a separate line for training costs, that's fine. Just, try to make it less stressful as possible for you.
Okay. Yeah, that makes sense. The inflation as well for the second year.
Yes.
I
So
also-
Marissa, did I answer your question?
Yes, I have a few questions. My
Go ahead.
second question is I'm kind of confused as to exactly how many spreadsheets we're supposed to turn in. I thought it was 3, but am I wrong?
No, I think that's right. You're going to do a spreadsheet for probably your WAC calculation. And probably I would incorporate it on that WAC calculation spreadsheet. I would like to probably be advisable to see your warranty, how you come up with your present value discounted warranty calculation. But you don't have to do that if you don't want to. But you're going to have one tab for your cost of capital, then have another tab for the product, the Detroit engine, and another tab for the product, the Marcus engine. Yes.
Okay, perfect. And
Depreciation is a no-brainer, really. You're just taking $1 billion and dividing it by 20 years. So that's not a big major calculation.
okay. And then the warranty cost, I do recall you said that it has its own separate line, correct, on the base analysis?
Correct.
Okay, and that's not under the input sides, that's under expenses, right?
Correct.
Okay. I think those are all my questions.
Okay.
Thank you.
And you might want to, if you're having a difficult time dealing with the warranty, the first part of today's review session, I went over that in quite detail. So if you want to look at that once I post it, that might be helpful to you.
Alrighty, thank you.
So for students who just clicked on, we are reviewing open item questions from our colleagues, our students here for our class in regards to the Road King case. If anybody has a question, feel free to ask it. I've recorded it for the last hour, or almost an hour. And so please, if you want to refer back to that recording later, you're more than welcome. We've talked about the warranty costs. We've talked about the paper setup, just things to help you finalize this work in this last week.
Thanks. Yeah, I was gonna jump on and ask a question about warranty costs, but if you already covered it, I'll go over the
Oh,
recording.
Chris, I can calculate. I can
Can you calculate it for me?
I can give you a quick summation of what I said. What's your question?
My question is regarding whether or not we should front load the cost into each unit, right? 5 years warranty is part of the variable cost for each unit that's manufactured. Because if we do it individual years going forward, then we don't really capture the expenses in years 16 through 20.
You said exactly what I said earlier. Each unit from year 1 through year 20 is going to have a warranty cost per unit times the 11,000 units you're producing in each one of those years, every year from year 1 through 20. And your calculation to determine that warranty cost per unit has to incorporate 5 years of costs in the assessment of the risk managers of this company. Road Kings have determined that every product produced, that every customer is paying $220,000 for each one of those buses, is going to have a warranty of 5 years. So within 5 years of that purchase date, the purchase date could be 2022, the purchase date could be 2032. But every one of those units will have a 5-year warranty that they can claim if something goes wrong. After those 5 years, no more warranty, but we have to incorporate and match those expenses of the warranty for those 5 years of costs every year into the year that that unit is being produced and sold. So yes, every year there should be a 5-year discounted present value warranty cost per unit times the 11,000 units being produced in each one of those 20 years.
That's what I thought. Thank you.
Okay, Chris. Good. Why I have you all in your attention now and you're kind of hanging out or looking at your notes or looking at your work. Remember, I have posted for our class the final examination problem and study guide as a review for that and what the examination is going to be. I'll be posting that early in this coming week. I think I'll be posting it on Monday, well in advance of our class on Wednesday, but I'll be posting the final so you can begin working on it. And I know you're going to be working on the Road King as well, but I'll be giving you plenty of time to do that in the last week of our course. Here is a study guide and an explanation of what's on that final. Remember, you're doing a final portfolio check on Friday, October 15th, your final valuation of your portfolio, which you'll be doing another spreadsheet and that sort of thing. So again, the final examination is going to be in 4 different installments or sections, a multiple choice on the first 7 chapters of our text, which is basically assignments 1 and 2 from our this past work, and there'll be multiple choice, basically definition or calculations of present value or something like that. The second section is I will be giving you a completed capital budget analysis of another company, and you're going to be interpreting that for me, answering me a series of questions about what that tells you. So I'll be doing a completed capital budget analysis and give you a copy of it in the exam. And I'm going to ask you a series of questions to interpret what that information is telling you. Kind of like what you're doing, but you're creating the spreadsheet in Road Kings, but I'll be giving you a completed one and you'll be looking at some key parts of that and telling me what you think. The third section is on short answers on these final chapters of the course: capital structure, dividends, percent of sales forecasting, and cash flow management. We'll be talking about percentage sales forecasting and cash flow management in our final class this Wednesday. And then the last section will be to update, but you can't do it until Friday, October 15th, of updating your portfolio for the entire term, gains and losses in percent and dollars, and then comparing that to the market index changes over that period of time to determine who's our Wolf of Wall Street. Do all that, and I will have the grades. Where's my little assessment here? Where did I put that? Oh yeah, here it is. Do all that, and I'll have our grades posted by Friday, October 22nd. Now, another thing that I'll be talking about this Wednesday and talked a little bit about last week is now under the course information area. I have your links for course evaluations. We're doing these a little bit differently now at the university. And if you click on this link, you can go based on your CRN number for our course and do the evaluation. You do those evaluations, I will post your course grade next week. Don't do them, that's okay. Doesn't affect your grade whatsoever. You don't want to deal with it. You'll just have to wait a little bit longer for the registrar to post your final grade. So if you go into Blackboard next week and you look at it, you'll see all your grades except your final course grade, which will be empty, and you'll just have to wait to get that for till the registrar posts it. Now, some of you say, well, I'm sorry, Mr. Hassey, I know each one of my grades, I can calculate it myself. Well, remember, each one of the grades throughout the course were weighted a certain percentage. Makes it a little bit more hassle to try to calculate that weight of those various grades to determine your overall course grade. But if you feel like you want to do that, go right ahead. But that's the process of this next week is once you complete everything, try to do the course evaluation. It helps me, helps the school. And at the same time, you can get your grade a lot quicker. So just a couple of highlights on that. And your final examination will be posted to the final examination file folder sometime this coming Monday. I'll be putting that together tomorrow. I'll be putting together an introductory video for that final examination. But again, we have class on Wednesday and we can go over this again in our class on Wednesday. Okay, I'll shut up. Any more questions? So what I'm going to do now for the last half hour of this review session is I'm just going to turn off my video. It's a better picture of me anyways. And just hang out here. And if anybody has any questions or looking over anything, I'm here. Just give me a shout out and I'll answer. Okay, Catherine, yes, I'll look for those people who have sent me their their spreadsheets in the last day. I will look over those and get back to you this afternoon. Thank you, Catherine.
Oh, thank you. Bye, everybody.
Hi, Professor. If it's not too much to bother, Jasmine and I are going to stay a little longer to get our Excel reviewed really quick.
Yes, no problem. As soon as everybody clears out, I'll bring up your spreadsheet on the screen and we'll look at it.